Hello, welcome to the TnT Podcast. This is Thomas Lindsey.
I'm Thomas Lindsey.
And we're actually in person today, if you can't tell. So, I'll go over to the other camera and show them what's up. Hello.
There he is.
Woo! Alrighty. Let's get started. We got part 2 now of the 2019 letter, right? Yeah.
Right. We left off on Mr. Smith got it right at the bottom of page 5. So we're going to continue with the non-insurance operations.
Yeah, wait. Let me pull up the chat on my iPhone really quick. So, in case there's any good chatters.
All right.
Let's see if it loads. Alrighty, the chat, we might have no chat this stream. We're just going to stay really focused on the letter, it looks like.
All right. You've got the letter pulled up?
Yes.
Okay. Non-insurance operations. Tom Murphy, a value director at Berkshire and an all-time great among business managers, long ago gave me some important advice about acquisitions. To achieve a reputation as a good manager, just be sure you buy good businesses. Over the years, Berkshire has acquired many dozens of companies, all of which I initially regarded as good businesses. Some, however, proved disappointing. More than a few were outright disasters. A reasonable number, on the other hand, have exceeded my hopes.
Oh, we got the chat, yo. Okay.
Okay, is anybody in there?
Yep.
All right, hello, chat. In reviewing my uneven record, I've concluded that acquisitions are similar to marriage. They start, of course, with a joyful wedding, but then reality tends to diverge from prenuptial expectations. Sometimes, wonderfully, the new union delivers bliss beyond either party's hopes. In other cases, disillusionment is swift. Applying those images to corporate acquisitions, I'd have to say it is usually the buyer who encounters unpleasant surprises. It's easy to get dreamy-eyed during corporate courtships. Pursuing that analogy, I would say that our marital record remains largely acceptable, with all parties happy with the decisions they made long ago. Some of our tie-ups have been positively idyllic. A meaningful number, however, have caused me all too quickly to wonder what I was thinking when I proposed. Fortunately, the fallout from many of my errors has been reduced by a characteristic shared by most businesses that disappoint. As the years pass, the poor business tends to stagnate, thereupon entering a state in which its operations require an ever smaller percentage of Berkshire's capital. Meanwhile, our good businesses often tend to grow and find opportunities for investing additional capital at attractive rates. Because of these contrasting trajectories, the assets employed at Berkshire's winners gradually become an expanding portion of our total capital. As an extreme example of those financial movements, witness Berkshire's original textile business. When we acquired control of the company in early 1965, this beleaguered operation required nearly all of Berkshire's capital. For some time, therefore, Berkshire's non-earning textile assets were a huge drag on our overall returns. Eventually, though, we acquired a spread of good businesses, a shift that by the early 1980s caused the dwindling textile operation to employ only a tiny portion of our capital. Today, we have most of your money deployed in controlled businesses that achieve good to excellent returns on the net tangible assets each requires for its operations. Our insurance business has been the superstar. That operation has special characteristics that give it a unique metric for calibrating success, one unfamiliar to many investors. We will save that discussion for the next section. In the paragraphs that follow, we group our wide array of non-insurance businesses by size of earnings, after interest, depreciation, taxes, non-cash compensation, restructuring charges, all of those pesky but very real costs that CEOs and Wall Street sometimes urge investors to ignore. Additional information about these operations can be found on pages K6 through K21 and pages K40 through K52. Our BNSF Railroad and Berkshire Hathaway Energy, the two lead dogs of Berkshire's non-insurance group, earned a combined $8.3 billion in 2019, including only our 91% share of BHE, an increase of 6% from 2018. Our next 5 non-insurance subsidiaries, as ranked by earnings but presented here alphabetically: Clayton Homes, International Metalworking, Lubrizol, Marmon, and Precision Cast Parts, had aggregate earnings in 2019 of $4.8 billion, little change from what these companies earned in 2018. The next 5 similarly ranked and listed: Berkshire Hathaway Automotive, Johns Manville, NetJets, Shaw, and TTI, earned $1.9 billion last year, up from the $1.7 billion earned by this tier in 2018. The remaining non-insurance businesses that Berkshire owns, and there are many, had aggregate earnings of $2.7 billion in 2019, down from $2.8 billion in 2018. Our total net income in 2019 from the non-insurance businesses we control amounted to $17.7 billion, an increase of 3% from the $17.2 billion this group earned in 2018. Acquisitions and dispositions had almost no net effect on these results.
Yeah, so let's talk about this a little bit. So it looks like the railroads are even growing. I was surprised because I'm like, who uses railroads anymore?
Well, who does use railroads? You know?
Lots of like shipping companies and stuff.
Yeah, a lot of freight, a lot of commodities are moved by railroads. I don't know how much BNSF moves as far as coal or oil or
yeah,
lumber or timber or paper or.
And then it looks like their non-insurance is going up, their insurance is going up, and the company's growing. So yeah.
Yeah, and you know, this was 2019, so
yeah,
it's grown since then. Is that going to be on the podcast?
Yeah.
Not sponsored.
Not sponsored. Yeah.
All right, I'm going to keep going. I must add one final item that underscores the wide scope of Berkshire's operations. Since 2011, we have owned Lubrizol, an Ohio-based company that produces and markets oil additives throughout the world. On September 26, 2019, a fire originating at a small next-door operation spread to a large French plant owned by Lubrizol. The result was significant property damage and a major disruption in Lubrizol's business. Even so, both the company's property loss and business interruption loss will be mitigated by substantial insurance recoveries that Lubrizol will receive. But as the late Paul Harvey was given to saying in his famed radio broadcasts, here's the rest of the story. One of the largest insurance of Lubrizol was a company owned by
Berkshire.
In Matthew 6:3, the Bible instructs us to let not the left hand know what the right hand doeth. Your chairman has clearly behaved as ordered. So, the company that they own was also insured by a company they own. So,
that's funny.
Property casualty insurance. Our property casualty PC insurance business has been the engine propelling Berkshire's growth since 1967. The year we acquired National Indemnity and its sister company National Fire and Marine for $8.6 million. Today, National Indemnity is the largest PC company in the world as measured by net worth. Insurance is a business of promises, and Berkshire's ability to honor its commitments is unmatched. One reason we were attracted to the PC business was the industry's business model. PC insurers receive premiums upfront and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now, pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float. And how it has grown is the following tables show. Do you want to read the year and float amount in millions?
Sure. So 1970, 39, 1980, 237 mil, Wow. So how many times increase in 1 year? Is that?
As a multiplier goes,
Yeah.
approximately 6x multiplier from
Wow.
1970 to 1980, but that's 10 years. It's not 1 year,
Yeah, I know, 10 years. And then 1990,
that's close to another 7 times multiplier.
Oh my goodness.
Between 6 and 7. I'm just off the top of my head.
Yeah, and then 2000 is like, whoa, that's like a 20 times multiplier.
Yeah.
And then in 2010, and then that is a 1 year, 2018 to 2019. I was like, what happened? Why did it only go up over 10 years?
But it did start to slow down.
Yeah.
But as the numbers get bigger,
it's crazy.
That huge multiplier is a little more difficult to sustain.
TnT is your favorite food. What do you mean by that? Chat. Alrighty.
We should look up TnT, what it is exactly. It's like, I could look it up and then we could say it. Anyway, we may in time experience a decline in float. If so, the decline will be very gradual. At the outside, no more than 3% in any year. The nature of our insurance contract is such that we can never be subject to immediate or near-term demands for sums that are of significance to our cash resources. That structure is by design and is a key component of the unequaled financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income the float produces. When such a profit is earned, we enjoy the use of free money, and better yet, get paid for holding it. For the PC industry as a whole, the financial value of float is now far less than it was for many years. That's because the standard investment strategy for almost all PC companies heavily and properly skewed towards high-grade bonds.
You have tissue? No.
There's some in the bathroom.
Okay. Yeah. Just my nose.
Well, Thomas takes care of that. I'll make a small plug for the Moomoo app. Is the Moomoo app in the description, the link?
Yeah.
Alright, so check out the Moomoo app in the link in the description. They have different promotions at different times. But if you download the app and deposit funds, then you can get one of the bonuses in the promotion.
Yes, alrighty. Let's continue with the moo and back to the letter.
Okay. But when we end, though, maybe we could show the Moomoo.
Link.
Yeah, follow the link. Your microphone tipped over.
Yeah.
All right. So the investment strategy for almost all PC companies is heavily properly skewed toward high-grade bonds. Changes in interest rates therefore matter enormously to these companies, and during the last decade, the bond market has offered pathetically low rates. Consequently, insurers suffered as year by year they were forced by maturities or issuer call provisions to recycle their old investment portfolios into new holdings providing much lower yields. Where once these insurers could safely earn 5 cents or 6 cents on each dollar float, they now take in only 2 cents or 3 cents, or even less if their operations are concentrated in countries mired in the never-land of negative rates. Some insurers may try to mitigate their loss of revenue by buying lower quality bonds or non-liquid alternative investments, promising higher yields, but those are dangerous games and activities that most institutions are ill-equipped to play. Berkshire's situation is more favorable than that of insurers in general. Most important are unrivaled mountain of capital, abundance of cash, and a huge and diverse stream of non-insurance earnings allow us far more investment flexibility than is generally available to other companies in the industry. The many choices open to us are always advantageous and sometimes have presented us with major opportunities. Our PC companies have meanwhile had an excellent underwriting record. Berkshire has now operated at an underwriting profit for 16 of the last 17 years. The exception being 2017, when our pre-tax loss was a whopping $3.2 billion. For the entire 17-year span, our pre-tax gain totaled $27.5 billion, of which $400 million was recorded in 2019. All right, we follow along with this? Is this all making sense?
Mm-hmm.
That record is no accident. Disciplined risk evaluation is the daily focus of our insurance managers who know that the rewards afloat can be drowned by poor underwriting results. All insurers give that message lip service. At Berkshire, it is religion, Old Testament style. Okay, so I don't know if we want to discuss. We might discuss this outside the podcast. Some of the details of this, what he's writing here.
Okay.
Because, you know what underwriting is and what underwriting risk is.
Not 100% sure.
That's why I'm thinking about we could look it up offline, because instead of giving you a definition that's poor, I mean, we could look it up.
Yeah, let's just look it up really quick.
Okay. Okay, so underwriting risk is the risk of uncontrollable factors or an inaccurate assessment of risks when writing an insurance policy. Underwriting is writing an insurance policy.
Oh, okay.
So if the insurer underestimates the risk associated with the coverage,
Yeah.
extending the coverage, then the insurer could pay out more
Than what they
get.
Yeah.
Right? So that's underwriting risk.
Yeah.
So Warren's saying,
I know.
if you don't get that right as an insurance company, yeah, then you might be subject to having to pay more than you got.
Yeah.
And in that case, it's hard to be profitable in that situation.
Mm-hmm.
So that's why he's saying disciplined risk evaluation is the focus, the daily focus of their insurance managers.
Yeah.
As I've repeatedly done in the past, I will emphasize now that happy outcomes in insurance are far from a sure thing. We will most certainly not have an underwriting profit in 16 of the next 17 years. Danger always lurks. So he said, for 16 of the 17 years, they did their underwriting with a profit.
Mm-hmm.
So, but he doesn't think that'll be the case going forward. Like 16 out of 17 is a tremendous achievement. It's an incredible record.
Yeah.
Mistakes in assessing insurance risks can be huge and can take many years, even decades, to surface and ripen. Think asbestos. A major catastrophe that will dwarf Hurricanes Katrina and Michael will occur. Perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source, such as wind or earthquake. Or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, Berkshire will get its share of the losses, and they will be big, very big. Unlike many other insurers, however, handling the loss will not come close to straining our resources. And we will be eager to add to our business the next day. Okay, so we already took a break and discussed most of this, but anything else to add or discuss about this?
Well, it's just interesting that, like, some insurance companies probably aren't thinking like of a crazy loss that could happen like that. So yeah.
Yeah, I don't know that he talks about it in this letter, but I remember either him writing or saying that some insurance companies, in an effort to win people's business, will write the policies like too cheaply, the premiums too low.
Yeah.
And because they're like, oh well, we want to win the business.
Yeah.
But then when they have to pay the claims.
Yeah.
That's when
they get out of
trouble.
business.
Yeah.
There was a Primerica video, and it was talking about since Primerica has started, over 1,600 insurance companies have gotten out of business, but they haven't.
Wow.
So yeah.
Wow.
So
how long ago did they get started?
1981.
Okay.
So yeah.
So that's 43 years now.
Yeah.
Wow. All right. Close your eyes for a moment and try to envision a locale that might spawn a dynamic PC. New York, London, Silicon Valley. How about Wilkes-Barre? Late in 2012, Ajit Jain, the valuable manager of our insurance operations, called to tell me that he was buying a tiny company, Guard Insurance Group, in that small Pennsylvania city for $221 million, roughly its net worth at the time. He added that Cy Fogel, Guard CEO, was going to be a star at Berkshire. Both Guard and Cy were new names to me. Bingo and bingo. In 2019, Guard had premium volume of $1.9 billion, up 379% since 2012, and also delivered a satisfactory underwriting profit. Since joining Berkshire, Cy has led the company into both new products and new regions of the country and has increased Guard's float by 265%. That's a pretty good return, pretty good result. In 1967, Omaha seemed an unlikely launching pad for a PC giant. Wilkes Barre may well deliver a similar surprise. Berkshire Hathaway Energy. Berkshire Hathaway Energy is now celebrating its 20th year under our ownership. That anniversary suggests that we should be catching up with the company's accomplishments. We'll start with the topic of electricity rates. When Berkshire entered the utility business in 2000, purchasing 76% of BHE, the company's residential customers in Iowa paid an average of 8.8 cents per kilowatt hour. Prices for residential customers have since risen less than 1% a year. We have promised that there will be no base rate price increases through 2028.
Dang, I wish that Berkshire and Hathaway was our energy provider, not Dominion. They like to up it up every year. And then by a good 1 or 2 cent kilowatt. It's like 17 in Falls Church.
Wow.
Cents. And they're saying it was 8, right? Or 9.
Average of 8.8 back in, but that was back in 2000.
Yeah. But if it's only going up 1% a year, that's not that much.
Yeah. In contrast, here's what's happening. All right.
Mm-hmm.
In contrast, here's what is happening at the other large investor-owned Iowa utility. Last year, the rates it charged its residential customers were 61% higher than BHE's. Recently, that utility received a rate increase that will widen the gap to 70%. The extraordinary differential between our rates and theirs is largely the result of our huge accomplishments in converting wind into electricity. In 2021, we expect BHE's operation to generate about 25.2 million megawatt hours of electricity in Iowa from wind turbines that it both owns and operates. That output will totally cover the annual needs of its Iowa customers, which run to about 24.6 million megawatt hours. In other words, our utility will have attained wind self-sufficiency in the state of Iowa.
Wow.
In still another contrast, that other Iowa utility generates less than 10% of its power from wind.
This is also interesting because I worked at Clean Choice Energy, and what they do is wind and solar through third party in DC. So, and we're in DC right now, so it's very interesting. Like, I'm like, hey, I do a little bit of computer. He talks about this. Hey, I do a little bit of insurance. He talks about it. Hey, I've done a little bit of this. Yeah.
Yeah, well, that's one of the reasons. To me, this is kind of like education for you.
Yeah.
And you're learning from one of the most amazing capitalists in the history of capitalism. Like,
yeah,
Warren Buffett's success as an investor is incredible, and
but he seems to be in the same things as me.
yeah, well, and that's another reason why I want you to learn from him.
Yeah.
Is because you already have some of that experience and some of that knowledge.
Yeah.
But this is somebody who has a lot more experience and a lot more knowledge.
Yeah.
And you can go from where you are.
To
Warren
Warren Buffett level.
Yeah, I mean, you can chart your own path and go whichever way you want. But
that would be awesome to be
right, as far as
worth what Warren Buffett's worth, even at his age.
Yeah. So.
And I feel like I have an advantage to Warren Buffett. We have all this technology.
We have all this technology. Plus, we have him to look at and be like,
yeah.
oh, what did he do? And what does he say? And, we can read his letters. And
yeah, so we have, like, a big advantage. Well, I do, I feel like.
Well, you're like he's not going to be around 90 years from now or 50 years from now, but
yeah.
You'll definitely be around 50 years from now. I mean, I sure hope so.
Yeah, I think so. Live to 120. Okay, both of us.
Yeah. All right. Keep going?
Yeah.
Okay, so in still another contrast, that other Iowa utility generates less than 10% of its power from wind. Furthermore, we know of no other investor-owned utility, wherever located, that by 2021 will have achieved a position of wind self-sufficiency. In 2000, BHE was serving an agricultural-based economy. Today, 3 of its 5 largest customers are high-tech giants. I believe the decision to site plants in Iowa were in part based upon BHE's ability to deliver renewable, low-cost energy. That's interesting. It's kind of buried in this letter of his that 3 of their 5 largest companies for BHE are now high-tech giants. My guess is that's to power data centers.
Yeah.
Right? I mean, what other electrical need do high-tech giants need? For cloud computing or for data centers? That's my guess. Continue on. Of course, wind is intermittent, and our blades in Iowa turn only part of the time. In certain periods, when the air is still, we look to our non-wind generating capacity to secure the electricity we need. At opposite times, we sell the excess power that wind provides to us to other utilities, serving them through what's called the grid. The power we sell them supplants their need for a carbon resource, coal, say, or natural gas. Berkshire Hathaway now owns 91% of BHE in partnership with Walter Scott Jr. and Greg Abel. BHE has never paid Berkshire Hathaway a dividend since our purchase and has, as the years have passed, retained $28 billion of earnings. That pattern is an outlier in the world of utilities, whose companies customarily pay big dividends, sometimes reaching or even exceeding 80% of earnings. Our view, the more we can invest, the more we like it. So that's a pretty big difference, like what he's saying here. Most utilities, they pay most of their earnings as dividends, but BHE does not do that.
Yeah.
And you'll notice Berkshire Hathaway does not pay a dividend either.
Yeah,
they
true.
retain their earnings and they invest them.
Yeah.
And so that,
in a way, that's I think that's smarter because
the company can grow more and faster, further, and bigger.
Yeah, and the thing is, like, the stock price will go up more than the dividend you're probably gonna get.
Right.
At least that's the goal.
Right. But the dividend gives you income that's money you can spend.
Yeah, which is nice, but I like Warren Buffett's style. If I'm gonna have a public company, I'm gonna do the same thing.
Yeah, well, it would be interesting, like when Warren steps down for being chairman, whether that's through retirement or
death or whatever it is.
If the if the next leadership continues to do that, or if they decide to start paying a dividend, I mean, that would be quite something if that were to happen. But I think Warren hopes that they just continue on the same path they've been on.
Yeah.
Today, BHE has operating talent and experience to manage truly huge utility projects requiring investments of $100 billion or more. That could support infrastructure benefiting our country, our communities, and our shareholders. We stand ready, willing, and able to take on such opportunities. Investments. Before we list our 15 common stock investments that at year-end have the largest market value, we exclude our Kraft Heinz holding, 325,442,152 shares, because Berkshire is part of a control group and therefore must account for this investment on the equity method. On its balance sheet, Berkshire carries the Kraft Heinz holding at a GAAP figure of $13.8 billion, an amount that represents Berkshire's share of the audited net worth of Kraft Heinz at December 31st, 2019. Please note, though, that the market value of our shares on that date was only $10.5 billion. So the market value was significantly below what they paid. Okay, so if you look at the...
Let's see. Oh, they own Visa. Visa, that's one we didn't see last time.
I'm pretty sure they still, even in 2024, are holding Visa. It's just not one of the top 15 as far as market value. But don't quote me on that. I'll have to look it up.
What's Charter Communications? That's also...
I think that was like a cable company or something like that.
Because that wasn't on there either. Everything else is the same, though.
I mean, we don't have to guess. We can look it up.
Yeah, look up Charter Communications. Uh-oh. We're going to have to end off the podcast episode soon. My computer's at 10%.
Okay. Well, let's finish this chart. But maybe we won't get to what chart communication is. Leave that an exercise for the viewers and for ourselves later. So I'm just going to read the last 3 paragraphs on page 10. Charlie and I do not view the $248 billion detailed above as a collection of stock market wagers. That's the total amount of the market value of the 15 largest equities that they carry, or stocks that they carry. Charlie and I do not view the $248 billion detailed above as a collection of stock market wagers. Dalliances to be terminated because of downgrades by the street, and earnings miss, expected Federal Reserve actions, possible political developments, forecast by economists, or whatever else might be the subject du jour. Du jour means of the day in French. What we see in our holdings, rather, is an assembly of companies that we partly own and that on a weighted basis are earning more than 20% on the net tangible equity capital required to run their businesses. These companies also earn their profits without employing excessive levels of debt. Returns of that order by large established and understandable businesses are remarkable under any circumstances. They are truly mind-blowing when compared to the returns that many investors have accepted on bonds over the last decade. 2.5% or even less on 30-year U.S. Treasury bonds, for example.
All right, we're gonna have to end here.
All right, download the Moomoo app.
Download the Moomoo app. We'll show that off really quick.
Using our link.
Use our link. Get some bonus.
And you have to fund your account in order to get the bonuses.
Yeah.
But that helps support us too. And we'll finish this next time.
We'll finish it next time. Sorry, this is a 3-part series for the one video, but we try our best. Oh, you changed it to the TnT Podcast for the.
I did.
Oh, that's cool. All right.